But it was anything but quiet in the financial markets today, with the Dow falling 3,000 points. The day began right in the red and quickly a trading halt, merely seconds after the market opened. The president then later this afternoon suggesting the viral outbreak may stay with us until the summer. Those comments kicking in another level of selling. And when it was all over, the Dow finished the day down 2,999 points, nearly 13%. That was the worst single day since the Black Monday crash of 1987, and the Nasdaq posted its worst day ever. Now, the sell-off coming despite unprecedented action from the Federal Reserve, slashing interest rates to zero in a surprise move last night. Let's get to CNBC's senior economics reporter, Steve Liesman, with more on the Fed's big move. Steve.
Brian, good afternoon. The reviews are in from the Fed's big move last night, and they were not very positive from markets. The sense was that it was not enough to resolve the problem, and if it was enough, it's certainly going to take more time. I want to go through all of the actions the Federal Reserve has taken because it's been an escalating series of steps by the Fed culminating, well, not culminating, but at least for the moment, the crescendo was last night with the huge moves that it's made. Let's start off on the 13th of March, where they cut rates by 50 basis points. On the 12th, they announced a total of $1.5 trillion in repo operations. The 15th, they cut rates to zero. That was last night, and launched $700 billion of QE. Finally, on this today, they did an additional $500 billion on offer. Now, don't be confused by the $500 billion. All the $500 billion means right there is that they're making infinity amount of repo available to the markets. Let's see some of the reviews we got today. Basically, the investment bankers and the people in the market that I talked to today said some U.S. funding markets, at least towards the afternoon, were still not functioning properly. It probably led to the afternoon repo by the Federal Reserve. I heard there was some better trading after that. Finally, there were huge submissions. The Federal Reserve, as part of that $700 billion, came in today, did $40 billion of Treasury purchases. There were many, many huge submissions for those. And like I said, a lot of people saying right now, Brian, the Federal Reserve should be doing more, perhaps a commercial paper facility, along with the Treasury to backstop corporate America. One more thing, Brian, we did our Fed survey over the weekend before the Fed came out. 40 respondents, fund managers, strategists, economists, many of the names who you know, they're saying now a 67% probability of a recession in the next 12 months in the United States. So, Brian, I think there's a big change here. One is that there is now pretty good or an odds-on bet of a recession in the United States, with the second quarter hopefully being the climax of that, maybe some rebound in the latter part of the third or the fourth quarter. And now some questions as to whether or not the Federal Reserve, because of the amount of debt out there, is it in the right place yet to address these issues?
But, you know, Stephen, we're going to get to Jim Bianco in a second. There's two types of recessions, okay? They're both painful, but there's one that is short, sharp, caused by an exogenous event, pent-up demand, as the president suggests, brings everything back once things get back to normal. And then there's that slow, painful slog, quarter over quarter, year over year. Is there any indication about which one this recession might be if we get it? Maybe if things clear up in third quarter, people they rush back out to restaurants, they buy a car they've been wanting to buy, they get back in the housing market.
Forgive the moment of levity, Brian, but there's an old Michelle Shocked album called Short, Sharp, Shocked, I believe was the name of it. So I think that's the odds-on bet here. I wish I had that full screen, guys. I don't know if you have that quarterly full screen that we were using, which shows the trajectory now looked at for the economy. Basically, it looks for 1.1% growth in the first quarter, minus 1.8%. These are annualized growth rates in the second, about flat in the third, and then the rebound to 2% happens in the fourth quarter. Look, nobody has modeled this before. It's very clear that this is all being done on an ad hoc basis. We're trying to model the shutting down of economic activity, which is essential to stop the spread of the virus. There's that full screen. It's great you guys put that up. And then also trying to figure out things like defaults. But also, don't forget that there's now talking about $50 billion of aid to the airlines, a large stimulus package coming through. A lot is going to depend on the stimulus package. I will say Powell last night was very clear. Public health first, fiscal stimulus second, and then in the third place is monetary policy. I think if those first two pieces can be put in place, we've got a chance of avoiding worse outcomes here for the economy.